Thank you for joining us for another episode of PROXUS Perspectives and Business Insights. I'm your host, Matt Roessler, Director of Business Development. As a human capital management technology provider, PROXUS has the good fortune to partner with many of the area's top professionals in employee benefits, human resources, and financial advising, as well as our area's top businesses and nonprofits. With a background in human resources management and consulting, I'm thrilled to have the opportunity to spend time talking with these individuals to bring you impactful perspectives and business insights. Join us periodically as we spend a few minutes diving into different relevant topics. So today I have the pleasure of speaking with Stephen Rossman, CPA and shareholder with Drucker and Scaccetti. Drucker and Scaccetti is a highly specialized CPA firm in Philadelphia focusing on taxation. Steve and his firm have provided tax and related guidance to PROXUS for some time, and we've called upon his expertise recently to help navigate the implications of COVID-19 legislation. In his practice, Steve performs tax compliance services as well as tax planning for individuals and closely held businesses. Among other things, Steve is a leader in DNS's law firm practice group, focusing both on law firm financial management and their individual partners with strategic tax planning. Steve holds a Master's of Taxation degree from Philadelphia University and is a member of both the American and Pennsylvania Institutes of Certified Public Accountants. Steve, thanks for spending some time with me today.
Hey, Matt, it's my pleasure. Thanks again for having me on the webinar last week, as well as having an opportunity to share some thoughts today.
Yeah, of course. No, we appreciate the extra firepower these recent weeks and days. And when you and I were talking a few days ago, you jokingly made reference to what you were calling the NeverEnding Tax Year of 2020. What did you mean by that? And what made you kind of use that name when we're talking about taxation for 2020 here?
Well, we CPAs, we always circle the date of April 15th as our day that we try and finish as many tax returns as possible. Obviously, there's extensions that go along with that. But April 16th and thereafter is our opportunity to kind of go fishing and catch up with our family lives and do normal things. But this has been the never-ending tax season for a number of reasons. First and foremost, with the COVID-19 crisis situation going on, the government has given the opportunity for individual taxpayers to not only delay the time that they have to file their taxes, but also delay the time that they have to pay their taxes. So normally taxes are due April 15th. Again, in normal times, taxpayers are given a 6-month extension if they ask for it. Now, an extension is normally an extension of time to file the taxes. It is not necessarily an extension of time to pay the taxes. So this year, the government said, we want to give taxpayers some cash flow opportunities and not have people come up with their tax liabilities for 2019 and also for 2020 estimates. For April 15th, they pushed not only the time to file, but also the time to pay to July 15th. That is kind of unprecedented from our standpoint, but it also makes our job a little bit tougher because while we used to have breathing room when it came to April 15th, now it's July 15th. It's kind of a double-edged sword, if you know what I mean, Matt.
Sure. No, and Steve, I know we're going to have a lot of people listening to the recording here that are in either New Jersey or Pennsylvania, Philadelphia, certainly where we're based, and we've got a good client base. Anything specific to that state or maybe the city of Philadelphia that goes along with this?
When I mentioned before that the government had given extensions for federal purposes, that was a true statement. Almost all states complied with that July 15th deadline for filing and paying of taxes. Right up until April 14th, in fact, New Jersey hadn't given an extension for taxpayers to file and pay. But literally on the night before taxes were due, New Jersey signed the legislation and it made it July 15th deadline for both payment and for filing for 2019 taxes for New Jersey residents. For Philadelphia, it was not quite the same. Philadelphia was a little bit more stringent, specifically the Philadelphia school tax, which is a tax on Philadelphia residents on their dividend income for the most part. Philadelphia felt that in an effort to help pay for the schools and help keep them going, they extended the due date for filing Philadelphia taxes to July 15th, but they kept the payment date as April 15th. A little disconnect there, but important for the Philadelphia schools to get some funding. And I understand why they did it. But again, there's that disconnect between when they had to when you have to file the taxes, which is July 15th, but they wanted to accelerate the payment for obvious reasons.
Sure. Okay. Yep. So a couple different things to keep, your finger on the pulse of state, federal, and local, certainly.
Right. And again, it just added to sorry to interrupt there, Matt, but it just kind of added to the never-ending tax season, as you can just imagine.
Absolutely. So talk to us about some of the tax options available to businesses under, the recently passed legislation. We've got the CARES Act, we've got the FFCRA, to help lessen the financial impact of what these organizations and businesses are going through.
Yeah, the government was very supportive of small businesses. There was the PPP loan program, which has run out of funding for the first part, but within days we'll have part two, which hopefully will go a lot smoother than part one, but that remains to be seen. And again, to pile on with the never-ending tax season, not only did we have the April 15th deadline for taxes from last year, but we were also inundated, at least at my firm, and I'm sure many other CPA firms across the country, with clients who needed to apply or wanted to apply for the Paycheck Protection Program PPP loans, which are a loan from the SBA, which if you do all the requisite requirements and you use the money or most of the money to pay your employees over an 8-week period, a portion or all of it could potentially be forgiven. So that was a frenetic exercise from basically April 3rd when they opened up the portal, or were supposed to open up the portal for businesses to apply for these PPP loans, through literally April 14th when they ran out of the first tranche of money. But again, legislation passed yesterday, at least through the House and going to the Senate, and should be signed and open up another $300 billion. So again, a never-ending tax season, as I said before. So that was one huge thing, which was out of the blue, which was a very rocky start to the program, and hopefully they learn from part one and they have some good insight on part two, but that's remains to be seen. So maybe another webinar we'll talk about that. Other things for businesses to kind of focus on, not so much in tandem, but another additive for businesses who are remaining in business and continuing to pay their employees. There's a hiatus. You can elect to defer your employer portion of your payroll taxes for the remainder of 2020. And then it's basically a deferral of paying the employer portion of payroll taxes for 2020. And then you pay half of whatever you deferred at the end of 2021, and then the other half by the end of 2022. And then there's also tax credits for rehiring employees, which are available to employers who are either bringing back people under the FMLA. In addition, there were several items that were under the TCJA, the Tax Cuts and Jobs Act, which passed for tax year starting 1/1/2018, including net operating losses that businesses prior to TCJA, meaning 2017 and before, businesses who had net operating losses, which we call NOLs, could be carried back 2 years and then carried forward until you used them up to like 20 years or so. What the TCJA, it limited businesses' ability to carry back NOLs, and they were all carried forward. In addition, it very much limited the amount that could be deducted in any 1 year. But what happened under the CARES Act, they rolled back all of those provisions relative to net operating losses that had been enforced or implemented due to the TCJA, and they just pulled them off. But in addition, so that being said, businesses can go back to 2018 and amend their returns for 2018 and use those NOLs and carry them back, but not only 2 years, they made it for 5 years. So there's a lot of opportunities, and again, to add on to the never-ending tax season, our summer is going to be busy, amending 2018 returns for businesses, preparing the 2019 returns that are on extension and using the new rules that roll back the NOL provisions that were taken away from the TCJA. So again, the whole idea that why the government did this was to, again, free up cash flow for businesses, because if they had limitations on the amount of net operating losses that they were able to use in 2018 for the 2019 returns that they're currently filing, if they can take those losses and carry them back to prior years, up to 5 years, like I said, they could get refunds and actually file them right away and ask for those refunds for prior years and get them now. So again, a nice opportunity there. One other, I'll call it a fix that was under the CARES Act that's for businesses. There was one provision for depreciation that was basically a mistake that under the TCJA. I don't want to get too technical, but there was special provisions that businesses could take bonus depreciation under the TCJA, which allows businesses that buy assets that when they place it in service, they could take 100% depreciation in year one. So it was nice that the TCJA gave that special bonus depreciation, which allows you to write off assets when you buy them versus taking them over the life of the asset, either 5 years or 7 years or whatever. But what they, I'll say, made a mistake in was assets that were qualified improvement property, it's called in my world, but leasehold improvements that had longer lives, that were more than 15 years. They said, no, you can't take bonus depreciation on those assets. It was the one asset class that they didn't allow businesses to deduct this bonus depreciation, the special depreciation, and take all of the deduction in year one. So you had to take it over 39 years or 30 years. You were able to recap that depreciation, but it was over a very long time. This rollback also included the fix that wasn't in the original TCJA that allows businesses to take 100% bonus depreciation for those longer lived assets. So again, another opportunity and another never-ending tax season to amend returns from 2018 and 2019 that weren't allowed to take that 100% bonus depreciation.
Okay.
So sorry for the long-winded, very technical explanation, but again, opportunities for us, but the tax season just keeps going and going and going.
No, listen, Steve. I mean, that's why we've got you on the call today, right? And that's why you're the expert in this field. And long-winded is as long as it's good, solid information. That's fine to take a couple extra minutes. So definitely appreciate that. And one of the things that I'm taking away from all of what you just said is there's a lot of nuance to this, right? There's a lot of minutia and information that certainly you and your colleagues have gone through. And I know on the PPP side and the tax credits, the interplay of all of these different things is important as well, because I believe I have it correct that if you did take a PPP loan, you can only defer the employer portion of Social Security up until the point that loan is forgiven. Is that correct?
That's absolutely correct, which is a little bit different than what we had talked about during our webinars. We had said they were mutually exclusive. If you got the PPP loan, you couldn't also ask for the deferral or ask for the tax credits. But what the government said was, you know what, we're not sure whether a lot of these businesses will actually get the PPP loans and or whether the loans will be forgiven. So until that time actually happens, you can do both. If you were fortunate enough to get the PPP loan, and if you're fortunate enough to get it to be forgiven, you can actually defer the paying the payroll taxes, as I mentioned, the deferral of the employer portion up until the loan actually gets forgiven. So really quick example, let's say you were approved on April 30th, you get funded on May 10th, and then there's the 8-week testing period where you're trying to pay as many of the payroll related and the other allowable expenses to get complete forgiveness. And then let's say it comes to July 15th, and then the government says the $100,000 that we gave you for your PPP loan, it's totally forgiven. From the time period from March 27th was the day that you could elect to defer those payroll taxes. You could go from March 27th to July 15th, the day that the government says you're forgiven, and then you'd still have to pay those taxes back in 2021 and 2022. But what we had mentioned on the webinar, we said if you got a PPP loan, you couldn't also do the deferral and take advantage of the employer tax credits. You can do both until the loan is forgiven. So you can still do all those things that we talked about on both sides of the benefits. But once you get the forgiveness of the PPP loan, you've got to stop doing the other two things if you were doing them.
Mm-hmm. But even so, in your example, there's a good period of time between, potentially getting that loan and actually having it forgiven. So, that deferral can quickly add up depending on the payroll, the size of the payroll.
Right. And the government was very clear in their FAQs and the guidance that they gave that it wasn't until the forgiveness happened. So even if you get the PPP loan and it's not forgiven, you could still defer the payroll taxes and also take those tax credits as well. So there's not even a prohibition. You don't even have to stop doing it when the forgiveness happens. You didn't get the forgiveness, so it was just a loan, and you still get the credits and or the deferrals.
Got it. Well, Steve, listen, I appreciate you sharing your time this morning and the information and your perspective on all of this. I'm sure, as we continue down this road, we'll be having you back on again as things continue to shake out. We do have your contact information listed there on the screen for all of our listeners, and I'm assuming it'd be all right with you if anybody had any follow-up questions to reach out directly.
Of course, it would be my pleasure. One other quick thing, Matt.
Yeah, please.
For all the folks out there, we have a very robust COVID-19 resource page on our website. So just go to www.taxwarriors.com, and then in the big red letters, COVID-19 Tax Resource Center. Click on that, and there's an abundance of blogs. There's an abundance of links to either individual state tax websites or the federal government. A litany of information that's really valuable that can help out in a number of ways.
Very good. Well, Steve, thanks again, and enjoy the rest of your week, all right?
You do the same. It's my pleasure. Thanks again. Thanks to all the folks at PROXUS for putting this together. Thank you, Matt, personally, for asking me to talk with you today. I appreciate it.